Good morning and welcome to your Financial Empower Hour. I'm Jason Cryderman. I'm here with my co-host, Mr. Tony Shore. Happy Sunday to our listeners. Happy Monday to you, Tony, as we record this show earlier in the week. We just were talking about Snowmageddon for here in Michigan. So here we are in Midland, and we didn't get as much snow, Tony, as they were calling for. There was quite a bit of snow they were calling for end of last week, over the weekend. We didn't get as much as they were calling for. We did get some high winds. We did get a lot of rain. It's pretty yucky and sloppy out there. Northern Michigan, and especially the Upper Peninsula, which if any of my viewers or listeners were up there at all, Northern Michigan and the Upper Peninsula got hammered on with snow. They got a lot of snow. Some spots calling for a foot, 2 foot or more of snow. And so when I was telling you that, Tony, before we started recording today, you said, oh, yeah. Well, Minneapolis, Minnesota, you guys got what you called Snowmageddon with almost a foot of snow. So how's it over there now?
Well, where I'm at specifically, I'm in my home studios today in Stillwater, Minnesota, and we got about just over 11 inches here. Certain areas in the area got up to 20. So it really ranged up north. They actually got less in this storm. And a little further south, they got more. And we were kind of in the middle. And we were on the east side, which got a little more. So we got 11 inches, and that's a lot. Yeah, and just an FYI on Stillwater, Minnesota, for all you listeners out there, all you Wisconsinites, Detroit, Michigananders. How do they say that?
Michiganders.
Michiganders. For all the people in Michigan listening and all the surrounding states, Stillwater, Minnesota is the birthplace. It's where the pop-up toaster was invented. So
no way.
I just want to.
Stillwater, Minnesota is where the pop-up toaster was invented. Well, we learn something every day, don't we?
You know what? I just the show.
No, that's what I call, useless trivia. Okay, so for my listeners and viewers, if we are ever in a game of useless trivia and that question pops up, what is the birthplace of the pop-up toaster? We can all stand up and cheer and yell, "Tony Shore, Tony Shore, Tony Shore, Stillwater, Minnesota."
All right, but seriously, it is. But so we have that going for us, which is nice. It's also the oldest. It was the first established town in the state of Minnesota.
Oh, really? Stillwater. Okay.
Stillwater, but it's not like God's country where you're at there in Michigan. I mean, that's beautiful.
Well, it definitely is. I mean, there's so many parts of Michigan that, I talk all the time about people, family or friends or clients that say they're going to travel and they're going to travel out of the state of Michigan or they're going to travel out of the country of the United States. And I say, well, have you been to ABC Michigan or XYZ Michigan? They say no. And I said, there is so darn much to see in this state of Michigan that if people would just, when you travel, spend your time traveling the back roads, the country roads, the unbeaten paths that you've never been to here in Michigan, just between the lower peninsula and the Upper Peninsula.
Even the Upper.
Amazing.
Yeah, the Upper Peninsula isn't hard for us to get to from Minnesota.
No, from you guys, it's really easy. Yep.
Yeah.
And there are so many beautiful, beautiful things between forest areas, between parks, rivers, lakes, obviously the Great Lakes, waterfalls across the UP. There's just so much here in Michigan. Minnesota is a great state as well, as far as like that.
Beautiful.
I'm not sure about downtown Minneapolis right now. I mean, it's
not the Twin Cities, but
different area down there. But
there's other things to see.
But with the lakes, the lakes and the hills and the trees, it's Michigan and Minnesota, I think, are two of the natural resource blessed states like that. And so,
the headwaters of the Mississippi are beautiful up there. The northern woods, and the north shore of Superior, it's beautiful. And of course, our 11,200 lakes, and lakes are, I think that has to be more than a couple square miles. I mean, there are a lot of
they're actual lakes. Yeah, they're
lakes.
big.
Yeah, we're not including ponds to get that number. So, No, that's it's beautiful. So is Michigan. But when it's covered in snow, I don't know. This time of year in March, I'd rather just skip the snow and get to spring, wouldn't you?
Well, yeah, I mean, I was talking with with our kids there last week when we had Monday was 60 some, almost 70 degrees, and of course the kids are Carson got to wear shorts to school because as soon as it hits 50 degrees, he wears shorts to school. He wear them every day, but we don't let him wear shorts to school if it's under 50. But as soon as it hits
I'm the
50,
same
man,
way. I'm breaking out the short pants if it's
yeah,
over 50.
he's in shorts and flip flops and whatever.
Oh, yeah.
He's just loving it, right? So
Comfort.
yeah, and it was such a beautiful, beautiful weekend 2 weekends ago. And then that Monday
nice.
that, he said, Dad, it's spring weather. I'm finally here. I said, Carson, you better get ready, bud. Cause it's, obviously it's only March, right? Mid-March. And I remember a lot of Aprils, even Mays where we had some snowstorms. So,
oh yeah, we had a blizzard in May a few years ago.
Yeah. I'm hoping it's not this year, but here we are as of recording this show. It's May 16th, Monday, the 16th, the day before St. Patty's Day. I'm sorry, 16th. March. Did I say May? Yeah. I'm sorry. Speeding up the clock here. Sorry about that. March 16th as we record, the day before St. Patrick's Day. Yeah. And we just had a heck of a lot of snow, some big storms over the weekend. Yep. Other than the weather though, Tony, you and I always like to touch base and catch up on, oh boy, for my viewers out there, those of you that are catching us on YouTube live, or those of you that are watching the recordings, would you take a look at that lid that Mr. Tony Shore, Tony,
this is my Irish hat. My grandfather used to wear this hat. It's got a little Celtic circle right
there.
Here.
It is. Yep.
Yeah. The Celtic circle on there for St. Patty's Day.
Oh, yeah.
This is the St. Patty's Day hat. And this hat was handmade in Ireland.
Handmade in Ireland. So that's
Donegal, Ireland. Yep.
Your grandpa used to wear that.
Yep.
This
was handmade. Yeah. My grandpa and my mom's side of the family is from Ireland. So I'm 50% Irish and 50% English. So I'm always at war with myself.
Oh, of course you are. Of course you are. Well, then this week's a big week for you and the family with St. Patrick's Day tomorrow.
It is.
Any big plan? What all did you do this past weekend, or any big plans coming up for this week then?
No, you know what? We would have went out. St. Paul is a big Irish town. A lot of Irish people in St. Paul, one of the biggest Irish populations. It's not as crazy as, say, Boston, but it's
sure.
And, Boston, Chicago, St. Paul, Minnesota, 3 big Irish towns built by the Irish, basically. But so they have a huge celebration. They block off 7th Avenue all the way down and have just a huge street party. They have a parade. And that's always fun to just go down there. The older I get, the less I want to go down there. Or the earlier in the day I go down there. I don't go down there at night anymore. That's for the youngsters. But not this weekend because we had Snowmageddon. So
did they still hold all the festivities?
You know what? They had some stuff during the day Saturday before it started snowing, but I think it all got canceled. Yeah. Tuesday, which is tomorrow, we're recording this on Monday. St. Patty's Day is tomorrow. And other than I work and other than wearing my Irish hat to work all day and on recordings all day tomorrow while I'm in the studio, other than that, probably not. I'll call my mom for sure, because she's 100% Irish, and wish her a happy St. Patty's Day. I always do. But other than that, no big plans. The older we get, I love St. Patty's Day. We would go out to eat or hit an Irish pub and have a little bit of some Irish food. We might eat a baked potato, just for kids. boil some food.
Yeah, absolutely. Yeah. No, I agree with you though, right? I mean, the older we get, and I'm sure a lot of my listeners and viewers feel the same, as we were younger and we would partake a little more in all these festive holidays but the older we get, and now with our kids being in school, when they always have something going on, whether it be track practice or baseball practice or something that'll consume our evenings, and then it's just home to get ready to for our next day work tomorrow. And we do like to partake in the green though. For us, we're not Irish, however, being Michigan State Spartans and our green and white, we dress up, my whole family, head to toe, in a lot of green and Spartan gear and partake. We usually have a little sticker, a button on that says, "I'm not Irish, but you can kiss me anyway," because obviously the button says, "Kiss me, I'm Irish." Well, we're not Irish, but you can kiss us anyway.
Sure.
We're good people. And but yeah, it's a festive time of year, with spring coming in. We got here we are, went through Valentine's Day. Now we're into St. Patrick's Day. Next thing you know, it's going to be Easter. We're going to be into the flower season of May and spring and June. And I just can't wait. It's a really exciting time of year.
Yeah, it is. I love this time of year. I do. I love spring. I love St. Patty's Day. I mean, fall is probably still my favorite time of year is fall, and that's the most beautiful time here in Minnesota. But I would like the snow to be gone. That's my thing right now.
Well, everybody, I think, over here, we all thought, snow's going to be gone, and then like you guys probably thought that as well. And then, snowpocalypse of last weekend, it's back, at least for a little while.
Yeah, it is. Well, hey, I'm going to ask you about risk. And once you hit retirement, how do you manage risk? And how do you prepare people for risk, financial risk in retirement? And I know that's a big part of what you do for your clients. So let's talk about that, how our listeners can be prepared for risk or deal with it. But first, I want to give away 10 more copies of your book. It's called Empower Your Retirement. And Jason and his dad, Carl, wrote a book called Empower Your Retirement. Plan for the best, but prepare for the worst. Great advice in there. Each chapter has great information to help you have a plan for retirement. You can get a copy by either calling the office, calling Great Lakes Investment Advisors, and setting an appointment to come in, or they'll mail you a copy at no charge, no obligation, not even postage. If you're one of the next 10 people to call the office and say you heard about it on the show, that number is 989-835-7203. That's 989-835-7203. And you can also set up an appointment at GreatLakesInvestmentAdvisors.com. And you are listening to your Financial Empower Hour. I am your co-host, Tony Shore, and I'm here with the man. Yes, Jason Cryderman is in the house. Jason, I'm excited about the show today. You've got a lot of great information, and this is one of the keys to a successful retirement, and that would be managing financial risk. And the reason I know you wanted to talk about this today is probably because of everything that's been going on. The markets have been going crazy. One day they're down drastically. The next day they bounce back because now supposedly we're escorting tankers through. If that doesn't work out, it'll be back down or somebody else will say something. So we're seeing a lot of up and down, and I think that scares a lot of people in or near retirement.
Yeah, it really does. I mean, you look at the short-term volatility we're seeing right now, and I want to stress right now, a lot of it is short-term, right? So like you say, one day at a time, one day it's up, one day it's down, one day it's up, one day it's down. And that's normal for what we're going through with these geopolitical concerns and, these there's all the concerns and issues we're seeing across the globe. But keep in mind, one day at a time, you're not investing your portfolio, or most people aren't one day at a time, right? You're investing for weeks, months, years, decades. So keeping in mind the big picture view and long-term view. Okay. So what we're going to talk about today is a great article, Tony, that you and I have been talking about, not only on today's show, we've talked about it quite a bit, and that's called risk proofing your retirement. How can you take the most risk off the table? How can you protect what you've built? Or while you're still growing your wealth, how can you protect it as much as possible? Because retirement really isn't just about growing your wealth. It's how do you keep it? How do you keep as much as you can of what you've invested over time.
Sure.
And Warren Buffett has two awesome rules, and you can Google Warren Buffett's 2 rules to investing, and you'll probably find in there somewhere where it says rule number 1, don't lose the money. Rule number 2, refer to rule number 1. And
don't lose the money.
It's great advice. And what that means is you work so darn hard to earn your money. You work so hard to invest it. You work so hard. And if you just don't pay attention and you lose it all, you let it go to market risk or longevity risk, inflation risk, healthcare risk, withdrawal risk. Those are really the 5 major risks we're going to talk about today. But if you don't pay attention to those risks, you will end up losing the money or losing too much of it. And that's not the best way to achieve the most successful retirement is when you're losing money.
Right.
Because ultimately the biggest fears, Tony, that retirees face, number 1 is running out of money. Number 2 is market crashes at the wrong time. And of course, market crashing at the wrong time is going to add to that fear of potentially running out of money.
Right.
Another big one is healthcare costs, right? Because healthcare could eat up a lot of the money. And so that adds to that fear of running out of money. So you think about a lot of the things as retirees that you think about that keep you up at night or concern you. Yeah. And they probably all circle right back to money. I could run out of money. That's going to cost me too much money. And so really those are kind of some of the fears we want to talk about today, because risk doesn't disappear in retirement. It changes. It changes a lot. So when you're younger, you have different risks and fears in life. When you're approaching retirement, your risks and fears change a little. And of course, when you're into retirement, your risks and fears, your lifestyle, the things that you're comfortable with, all that changes as we age and we get into retirement.
Yeah. Well, let's talk about the first one you mentioned. We're going to go through these risks, market risk, because that's top of mind for everybody right now. And sequence of returns and market risk. So market risk in retirement would be if you have to withdraw, you're withdrawing money out of the account, and then the market, your money is all in the market in a 401k or traditional IRA, then the market drops or has a correction of 10, 20%, and you're still pulling money out each year or each month to live on. That's the big problem in retirement, right? Is that what market risk is in retirement? Well,
that's a big, actually what you hit on there, Tony, was actually 2, if not 3 different risks in retirement. One is just simply market risk. Let's not even talk about taking income yet, but that's another. We'll add that in just a couple minutes here in another segment, probably, because withdrawal risk in retirement. If you're withdrawing too much, or like you just said, Tony, if you take on too much market risk while you're withdrawing, now you have it's a double negative. It's compounding negatively in the wrong way. And that can be very drastic and devastating on a retirement portfolio. But before we get to withdrawing, even just getting into retirement, as we get into retirement, you're going to have some form of risk inside your portfolio. And generally people in their 20s, 30s, 40s, even 50s have more tolerance for risk. They have more time on their side. Maybe they're still contributing. They don't need to think about accessing the money quite as soon. And again, they're okay with a little more risk. As you age and you get closer and into retirement, most people become a little more conservative. They don't like risk as much. They don't have as much time on their side. They can't afford to lose as much because they're not contributing anymore. And we generally just get a little safer and a little more conservative in our overall lifestyles, especially in our portfolios when it comes to money. So we got to be careful how much risk we have in our portfolio when we get into retirement, because then there's something called sequence of risk returns or sequence of returns. And that is, if we lose too much money too early in retirement, it can devastate us, right? So sequence of returns is if your first 3 years you were down 3%, or I'm sorry, in the first 3 years you were down every year, versus if your first 3 years you were up every year. Well, obviously, if you are up every year or not down as much, you're going to have more money in your portfolio. So controlling your exposure to risk, you could have the two retirees that have the same exact average returns, but if one of them lost more money in the first few years and the other one didn't lose as much in the first few years, the outcomes, the amount of money they have left in their portfolios is going to be drastically different. So the key takeaway, Tony, to this market risk and sequence of returns risk is timing matters more than averages. So timing how much risk you have, when you have the risk, when you lose money, how much you lose, it's going to mean a lot more than average returns. And so that's something really to take into consideration. What I call in the retirement red zone, when you're about 3 to 5 years or so away from retirement and the first 3 to 5 years into retirement, those are the most crucial years. You're going to want to manage that risk for an unfortunate sequence of returns. I can't hear you, Tony.
So what are some strategies, Jason, that you utilize or our listeners out there can utilize to manage market risk and sequence of returns risk?
Great question. So I'm going to touch on these, and you termed it great, right? Rather than say what's a plan, it's a strategy, right? There's multiple strategies that you can employ. Now, this isn't direct advice for any one person out there, because obviously I need to get to know more about individuals and families and what position you're in to determine which strategies are most appropriate and in your best interest. But just to name a few out there that some of you may already be employing, or you may want to look at. You may want to do some due diligence, spend some time and look into. Number one is what we call bucket strategy. That's where maybe you do a short-term bucket, a medium-term bucket, a longer-term bucket, and you can even do risk bucketing strategy. So you can have conservative risk, moderate risk, and more aggressive risk. And generally, the higher risk would be the longer-term bucket. You can do what we call reduced volatility near retirement. So as you get closer to retirement, you reduce your exposure to volatility. And you can do that through your allocation exposure and your diversification exposure. And that's the next, I guess, strategy would be diversify beyond stocks. Get out of just the normal stocks, mutual funds, bond world. Look at other alternative investments like REITs, like maybe fixed indexed annuities, maybe multi-year guaranteed annuities, other types of investments that you may not have had exposure to inside a 401k, may not have had an opportunity to utilize, or in your accumulation years just might not have been in your best interest. But now that you're looking to minimize your risk exposure, may be more appropriate for retirement. And then the last strategy, and I try to employ this with all my families all the time, no matter what age you are, no matter what phase of life, investing, or retirement you're in, avoid panic selling. This is a big one, Tony, especially right now. People are freaking out with everything going on in the Middle East and prices up, prices down, markets. Avoid the emotional panic selling. That is probably the number one thing that can destroy the most wealth is emotional panic selling.
Yeah. Yeah. People let their emotions, they worry because of, say, the war in Iran, or something China does, or politics here at home, or there's a report that isn't as good as we'd hoped it would be on employment or interest rates, or inflation ticks up. And maybe the value of the dollar drops, and then people panic and they think, I got to sell everything. I got to move everything to cash or move into 100% gold. You don't want to make those emotional decisions. You want to work with a trusted financial services professional. And I'm not going to name names, Jason Cryderman, but I happen to know a guy. And
I appreciate that.
And you have a whole team there at Great Lakes, that investment advisors, to help people with this so they don't make an emotional decision. And I want to let all our listeners know they can actually have a no-charge strategy session. You'll sit down with them, look at where they're at. They can get to know you. And then you'll say, hey, we can run some reports for you. Here's where you're at. And if they choose to work with you moving forward, fine. If they don't, it's no problem. You don't sell them anything. It's great. You just talk to them about where they're at or answer their questions. So listeners out there, take advantage of this offer and set up a no charge, no obligation consultation with Jason Cryderman and his team. That's 989-835-7203. Just call 989-835-7203 and set up that consultation. You'll also be able to get a copy of his book if you do so. Just mention that you heard about it on the show. And this is your Financial Empower Hour. I'm Tony Shore. I'm here with Jason Cryderman. Jason, great show so far. We've been talking about risk-proofing your retirement. You want to protect what you've built. You always say that to me, Jason. Protection is key, and managing risk is key. You talked about market risk. You talked about sequence of returns. Now let's talk about something that is very interesting to me, and because it's really affected my family, and that is longevity risk. My grandfather lived to 101. Most of his brothers and my dad's uncles and aunts lived into their 90s or 100s as well. But that's not necessarily normal for all families, but people are living longer and longer. Every year, more and more people live to age 100. Right. And with health, so longevity is actually a risk. The good news is we're living longer.
That's great news.
The bad news is we're living longer.
We're living longer. Yep. No,
right.
You're right. It's that double-edged sword thing, right?
Yeah.
We're living longer, but that means our money has to last that much longer. The longer we live, people have a chance to become more susceptible to debilitating sicknesses, diseases, ills, whatever it might be, which again costs more money. And a lot of times people, they didn't save enough, realizing they might live longer than anticipated. People are living a lot longer than ever. Retirement now can last 25, 35, even over 40 years. And we're finding a lot of people end up being retired longer than they were working. And not many people plan for that. When you start your careers and you invest over time and you think, gee, if I retire at 65 and 70 and I'll live till probably 85 and then retirement's over. So you plan for maybe 15, 20 years of retirement resources. Well, unfortunately, fortunately we're living longer, but unfortunately it costs a lot more money to live longer. And a lot of people, number one, either they spend too much too early, and we call it your go-go years. When you first retire, you go, and you spend a lot of money. Well, if you spend too much in your go-go years, you may not have enough left when you get to your slow go or your no-go years. So you got to make sure you've saved enough, number one, and then your spending is appropriate to sustain that amount of income or amount of money in the portfolio to provide you longer income. And some people may just be way too conservative in their investing because they're afraid to take on risk, but they're not earning enough to support the income and the lifestyle for more than 10, 15, 20 years of retirement.
Sure.
So we got to talk about how do you manage longevity risk if you are fortunate enough to live longer. We all love to live another day on this earth. It's wonderful. We pray that we have good health. We pray that we can live longer. But how do you manage the risk? And one of them is your withdrawal rate discipline. So it's important. A lot of people always ask me, how much can we afford to withdraw out of our portfolio? And number one, maybe never touch the principal. Or they might say, how much can we afford to withdraw over our lifetime, knowing we're going to eat into some principal, but we just want to make sure we don't run out of money. And the rule of thumb a lot of people are using now was I think it came by Fidelity, actually, is what we call the 4% rule. And again, it's just a rule of thumb. It's just a guideline. Some people are able to withdraw a heck of a lot more than 4% and they'll be just fine. However, other people, 4% is even too much money to withdraw, and you're still going to have a fear of potentially running out of money, depending on how much you have in there, how much you're earning, taxation, fees. There's a lot of other variables that come into play. So, but you want to pay attention to your withdrawal rate. You want to pay attention to the risk exposure. You want to make sure you're maximizing what we call guaranteed income sources, Tony. And the guaranteed income sources are Social Security. Yeah. Maybe you have a pension. If you have a pension, that's an awesome opportunity of income source to guarantee. And if, let's say, you don't have a pension, you do have Social Security, but obviously most of us know Social Security is not meant to supply 100% of the income to live your entire retirement lifestyle. It's
not even close.
It's designed to supplement retirement income. And what we found, it's anywhere maybe from 10 to 30%, meaning the remainder of your retirement lifestyle is going to come from somewhere. Most of the times it's from your individual portfolio. And what is the only investment tool or vehicle that you as an individual person can own inside your portfolio that will guarantee a paycheck? We call it mailbox money. It'll guarantee a paycheck every single month for the rest of your life. That tool, Tony, is an annuity.
Yeah, which is basically what Social Security and pensions are. They're
essentially
forms of annuities, right?
Yep,
and so and annuities, certain types aren't great. They can be high in fees and you got to watch it. And they can still have risk. But there's been so many changes and they've improved them because that market has gotten so competitive, and they really saw a need when pensions went away. People needed guaranteed income in retirement. Right. So I know I have a lot of folks that come to you, and what fits with them might be a fixed index annuity, right? With little to no fees.
Correct.
And principal protection. So you're never going to lose that principal, right?
Yeah, there's all kinds of, and that's a good thing to point out. First of all, let's annuities are issued by insurance companies. And so you want to make sure it's a strong, healthy insurance company, because the annuity is backed by the claims paying ability of that insurance company. So you want to make sure you're utilizing strong, financial, stable companies. I highly recommend that. And, there's a lot of different types of annuities. As you mentioned, Tony, we could have a growth annuity. We could have a safe annuity. We could have a guaranteed annuity. We can have an income annuity. There's so many different types of annuities that you really want to make sure that the tool you're using, and if annuity is the tool, just make sure it's the right tool for the job you're trying to accomplish. So if you want income, but maybe you're using a high fee, high risk annuity that doesn't provide guaranteed income, Well, it doesn't mean that annuity was necessarily bad. It was the wrong annuity, the wrong tool for the goal or objective you were trying to accomplish.
Sure.
If you don't need income and you end up having a guaranteed income annuity, well, you're probably missing out. It was probably the wrong tool, again, the wrong product for you. So, but again, an annuity is the only investment vehicle, the only tool that will provide you and your spouse a guaranteed lifetime paycheck. And the cool thing about the proper annuity, Tony, it's got to be the right one, is you can run out of money. You can never run out of income. And that is really, really powerful. That's really huge. Comforting when people's number one fear in retirement is what? Running out of money.
Running out of money.
Can you put money in a stock, a bond, a mutual fund, a CD, any other type of investment vehicle out there? Start taking an income off that and guarantee you'll run out of money but never run out of income. The annuity chassis, if it's the appropriate annuity, is the only vehicle that's designed to provide guaranteed income for life.
Yeah. And it depends on your situation. You don't want to put all your eggs in one basket either. You still
Absolutely
need
not.
The bigger growth in investments and in the market. So it's a balance that you work hard, and that balance is different for every individual. Speaking of different for every individual, you mentioned Social Security is one thing that helps you manage longevity risk or running out of money. And you want to maximize that, right?
Yeah,
and file at the right time for your situation.
Yep, maximize Social Security is another one, Tony. I hate to cut you off there, but I get excited when you say this. I'm like, yeah, because I want our listeners to understand how important that is, right? Delaying your Social Security is going to mean higher guaranteed income later, but there's a lot of variables you need to take in consideration for you in your individual position or your family's position, because for some investors, absolutely, you should delay Social Security until full retirement age or even longer. However, depending on your situation, you may want to take Social Security a heck of a lot sooner than some other people do. So thank you for pointing that out, Tony, because that's very vital. And a lot of people, unfortunately, we've met over the years, they say, well, we took Social Security. I said, why did you take Social Security when you did? Well, that's what my brother did or my sister. That's what my neighbor did or so. Right. You just got to make sure that what you're choosing to do is 100% best for you.
Sure. All right. Well, let's take a quick break before we go on to the next risk and give our listeners a chance to get another copy of your book at no charge. We're going to give away 10 copies of the book, no charge, no obligation. We're not even going to charge you shipping. And it's a great book, Empower Your Retirement. And for our viewers, he's holding it up on the YouTube video. Empower Your Retirement, Plan for the Best, Prepare for the Worst. To the next 10 people that call Great Lakes Investment Advisors, and if you leave a message there, say, I heard about it on the show, I want a copy of the book, leave your information. It's 989-835-7203. You can also just call if you have questions, and we'll send you a book if you're one of the next 10 callers. 989-835-7203. And this is your Financial Empower Hour. Our host is Jason Cryderman. I'm your co-host. I'm along for the ride, just learning a lot from you today, Jason, about how to manage risk, especially in retirement. And so far, you've talked about market risk. You've talked about longevity risk. What about inflation? I know people worry about inflation, and as well they should, because in retirement, you're no longer earning that regular income. You've got to live off your savings, off Social Security. But if you just kept the same amount, if you put all your money under the mattress or in a checking or savings account, you're not going to keep up with inflation. So inflation is a risk, right?
Yeah, inflation's a big one. That's a good thing to point out, Tony, that if some people can be what we call playing it too safe. Playing it too safe can add on additional risk, like maybe interest rate risk, which is another term for inflation risk, because inflation can very quietly but very aggressively erode your purchasing power. Even a 2 to 3% inflation can cut your buying power in half over time. And The longer we live, if we have a 2 to 3% inflation, but where our inflation risk is too high inside of our portfolio, the longer we live, that could be very, very devastating against a retiree's portfolio. so the couple risks that we face there. Well, I want fixed income in retirement, right? I want fixed stuff. I don't want stuff in the stock market as far as when I look at my investments. Well, fixed income can actually lose value if your fixed income vehicles are not staying ahead of inflation. So that's important to take a look at. When we look at traditional bonds or different types of fixed income vehicles, you have to make sure they're staying ahead of inflation. You have to also understand the long-term expenses, because your long-term expenses, if you don't understand them or you underestimate them, how much does 0.5% or 1% or 1.5% or 2%? What does that mean not only today, but what does that mean long-term coming off of a portfolio?
Well,
if we have 2 to 3% inflation, we have 1.5% fees, we have some risk in the portfolio, we're needing to pull out some income. All those variables need to be added up in that equation to determine how much income are you going to be able to pull out. And based on the results of those equations, based on the variables in the equation, are you risking running out of money? Do you know
because those bills, those monthly bills that you can estimate, okay, here's what I need to live in retirement. But that number is going to go up in 10 years because the bills are anyway, because groceries don't ever get cheaper.
Right,
Gas rarely gets cheaper. The only thing I know that costs less over time are television sets. Otherwise, it's the only product we buy that actually goes down in price. Once in a while, oil will dip down. But for the most part, it will still, on a grand scale over your entire retirement, it'll go up too if you look at the chart or the graph. So the bottom line is, gas used to be 99 cents. We're not going to get there again. Probably
not. We'll probably never be there again. Right?
So even gas, the only thing I've seen consistently go down in price, there's only one item that consumers purchase, and that's televisions. I don't know why. We're not going to get into that today. We could probably do a whole show if we could only take live listener calls. I'm sure some people have opinions on that, why that happens. Why isn't it bread and eggs and milk and groceries that goes down every year instead of TV sets, right? That's my thing.
Well, I agree.
Yeah, or why doesn't my rent go down like TV sets do?
Why isn't my mortgage going down? I don't know. My car payment, none of those things go
health
down.
Insurance is definitely not going down.
Well, and we're going to touch on that. That's a good one. You jumped on healthcare. So let me finish up here on the inflation risk, because healthcare is a big one. I'm glad you mentioned that. So we're going to flow right into that one, Tony. But some strategies you want to keep in mind when you're investing your money to make sure you're not going to get eroded, your purchasing power is not going to be eroded over time by inflation, is you need to keep some growth stocks in your investments, some stocks, some real estate, some REITs, some mutual funds, whatever it is. You need to keep some exposure to growth. Growth is designed to outpace inflation. You want to use some inflation adjusted income and sources. So if you do have something in your portfolio like an annuity that provides guaranteed lifetime income, does it have inflation adjustment? So every year your payment from that annuity goes up by 2 or 3% per year. That's really what you want to try to put into play inside your portfolio, is something that has inflation adjusted income built in, because we have to plan for rising costs. If we're not planning appropriately for food, utilities, insurances, as you mentioned, Tony, if we don't plan for that stuff to go up, we are already setting ourselves up for failure. Plan for it to go up, and plan your investments to go up at least that high, if not higher. Because again, playing it too safe can actually be too risky inside of an investment portfolio.
Right. That's huge. Okay. Really quick, healthcare and long-term care. We've done whole shows on this, so we don't need to belabor the point. We only have a couple minutes left, but it is a risk, a financial risk in retirement, isn't it?
It really is. So healthcare isn't just healthcare risk isn't just a medical issue. It's a financial one. Okay. So one of the biggest unknown expenses in retirement, in life, is healthcare.
Yeah.
One of the biggest misconceptions out there is, Medicare will cover it. Well, no, it will not. Medicare does not cover everything. Remember, most people that think they're going to be covered by Medicare or their insurances, when it comes to long-term care, they're wrong. They're flat out wrong. Medicare doesn't cover everything. It doesn't cover long-term care. It doesn't cover extended home care. It doesn't cover assisted living. And a majority of retirees will need some form of long-term care.
Yeah.
especially a married couple, the chances are even higher. So what can you do? Well, you can have HSAs, health savings accounts. You can have long-term care insurance. You can buy hybrid insurance products like an annuity or a life insurance that has long-term care benefits built in. You can self-fund your own strategy. But again, maybe one of the biggest unknowns is in retirement, healthcare costs. And again, healthcare risk isn't just a medical issue, Tony. It's a financial one, and you need to plan and prepare for this appropriately and properly ahead of time, or it could devastate you in retirement.
Yeah. And there are strategies. Again, I encourage our listeners to pick up the phone, give Jason a call. We're going to give away a few more books. Call 989-835-7203. Mention that you heard about it on the show. Ask for a copy of the book. And most importantly, set up that no charge, no obligation consultation. Sit down with Jason and his team there. Get your questions answered. Again, the number 989-835-7203. Jason, great show. Listeners and viewers, that does it for today's episode of your Financial Empower Hour with our host, Jason Cryderman.